Look, I need you to imagine something for a second. You open a brokerage app because you've finally decided you're going to start investing. You see a stock trading at $50, but then you see PE ratio, market capitalization, EPS, beta, volume, bid, ask, ETF, and suddenly it feels like you accidentally walked into a conversation between five Wall Street professionals. You start wondering whether you're missing something everyone else already knows. So you close the app and tell yourself, I'll figure it out later. Later never comes, because the industry feels like it was designed to keep regular people out. That stops today. Hey, I'm Brian, and I spend way too much time thinking about how to make money and investing concepts simple enough that you can actually use them. In this video, we're going through the stock market vocabulary you need to understand what you're buying, what you're looking at, and what all those numbers actually mean. So if you've ever felt like investing has its own language, stick around, because by the end of this, that language is going to feel a lot less intimidating. Here's the reframe. The stock market isn't difficult simply because the underlying ideas are incredibly complicated. A lot of the difficulty comes from the fact that beginners encounter dozens of unfamiliar terms before they understand the basic idea underneath them, and that confusion can be expensive. Dalbar's long-running investor behavior research has repeatedly shown that the returns earned by average investors can lag the returns of the broader market because of behavioral decisions. Think about that. You can understand enough to open the account, but if you panic, chase performance, or constantly jump in and out, the cost can eventually be measured in thousands of dollars. So let's remove the language barrier first. Let's start with the word you'll hear constantly: stock. A stock represents ownership in a company. If a fictional company has 1 million shares and you own 1,000 of them, you own 1,000th of that company. That ownership can potentially benefit you in two main ways. The company can become more valuable and your shares can increase in value, or the company can distribute some of its profits to shareholders through dividends. Now, a share is simply one unit of that ownership. Imagine Company A has 1 million shares and each share costs $50. The company's market capitalization is $50 million. Now imagine Company B has 10 million shares, but each share costs only $10. Its market capitalization is also $100 million. So Company B has the lower share price, but is actually the larger company. That's why staring at the share price by itself can be misleading. Market capitalization, or market cap, is basically the market value of all the company's outstanding shares. You'll often hear companies described as small cap, mid cap, large cap, or mega cap based on their size. The exact boundaries can vary, but the important idea is simple. You're categorizing companies by overall value, not by whether one individual share looks expensive. Now you might be thinking, okay, but where do these shares actually trade? That brings us to exchanges. The New York Stock Exchange and NASDAQ are two major United States stock exchanges. But don't fall into the trap of thinking one is automatically better just because of its name. For most beginners, liquidity matters much more. Liquidity means how easily you can buy or sell something without significantly moving its price. A highly liquid stock might have buyers and sellers constantly available. A thinly traded stock may have much wider gaps between what buyers offer and sellers demand. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Now let's separate two words people often use interchangeably: investing and trading. Investing generally means buying an asset because you believe the underlying business or asset can create value over a longer period. Trading focuses much more heavily on shorter-term price movements. Neither word magically makes an activity good or bad. The important question is what you're actually trying to accomplish. Here's where psychology enters the picture. Imagine you invest $100,000 and the market drops 20%. Your account is now worth $80,000. A beginner might think, I'm losing money, so I need to get out before this gets worse. Here's the psychological mistake: confusing an uncomfortable price movement with permanent damage to the underlying investment. Sometimes a decline really does reflect deteriorating fundamentals. But sometimes, the market simply becomes pessimistic temporarily. That's where bull market and bear market come in. A bull market generally describes a sustained period of rising prices, while a bear market describes a sustained period of falling prices. A correction is a significant decline from a recent peak, while a crash is a much more severe and rapid market decline. Here's the thing. You don't control whether the market becomes bullish or bearish. You control how you respond. Dalbar's research on investor behavior is important here because it has consistently highlighted the gap that can occur between market returns and the returns investors actually earn when emotions influence their decisions. The market falling isn't automatically your biggest mistake. Panic selling at exactly the wrong moment can be. Now we get to some of the terms that make stock market beginners feel like they need a finance degree. EPS and PI. EPS stands for earnings per share. In simple terms, it tells you how much of a company's profit is attributed to each outstanding share. If a company earns $10 million and has 1 million shares outstanding, its earnings per share would be $10. The PE ratio, or price-to-earnings ratio, compares a company's share price with its earnings per share. So if that company earns $10 per share and the stock trades at $100, the P is 10. If another company also earns $10 per share but trades at $200, its PE is 20. Now here's the psychological trap. Beginners see the 10 times earnings company and say, "That's cheap," while looking at the 20 times company and saying, "That's expensive." But here's what nobody tells you. Valuation only makes sense in context. Imagine company X has a P of 10, but its profits are barely growing. Company Y has a P of 25, but its profits are growing rapidly, and the business has a much stronger outlook. Company Y may look more expensive based on one ratio, but that doesn't automatically mean it's the worst investment. That's why professional investors examine growth, profitability, debt, industry conditions, competitive advantages, and future expectations alongside valuation. The statistic here isn't that some magical P/E number guarantees success. It's that valuation ratios are tools, not verdicts. You should never look at one number and assume it tells you the entire story. And this leads to a broader category of stocks you'll hear about. Growth stocks are generally associated with companies expected to grow faster. Value stocks are generally associated with companies whose shares appear relatively inexpensive compared with certain measures of the business. Blue chip stocks usually refer to established, financially substantial companies. Cyclical stocks tend to be more sensitive to economic conditions, while defensive stocks tend to have businesses that may be more resilient when the economy weakens. Simple? The definitions are. The decisions are where the nuance begins. Now let's talk about dividends, because this is another term that sounds more complicated than it is. A dividend is money a company distributes to shareholders. Imagine you own 100 shares and the company declares a dividend of $1 per share. You would receive $100 before considering any applicable taxes or other factors. But here's the psychological mistake: thinking that dividend money appeared from nowhere. A dividend is a distribution of company value to shareholders. Around the ex-dividend date, the share price is generally adjusted downward by approximately the dividend amount, all else equal. So a dividend isn't a magical extra return disconnected from the value of the company. What matters is your total return, changes in the share price, plus distributions you receive. Then there's the dividend yield. If a stock pays $2 per share annually and the share price is $40, the dividend yield is 5%. Sounds great, right? But here's the catch. A high dividend yield doesn't automatically mean a better investment. Sometimes a high yield exists because the share price has fallen sharply, or because the market believes the dividend may be difficult to maintain. Companies can also return money to shareholders through share buybacks. Instead of distributing cash directly to shareholders, a company can use money to repurchase some of its own shares. If the number of shares outstanding falls while the company's earnings remain unchanged, earnings per share can potentially increase because the same earnings are spread across fewer shares. Now, when you actually buy or sell a stock, you'll encounter order types. A market order tells your broker to execute the trade at the best available price. A limit order tells the broker the maximum price you're willing to pay when buying, or the minimum you're willing to accept when selling. A stop-loss order is designed to trigger an order when a specified price level is reached, although execution price isn't guaranteed in fast-moving markets. And then there's the bid-ask spread. The bid is what buyers are currently offering, while the ask is what sellers are currently requesting. The difference between them is the spread. Here's what nobody tells you. The price you see on your screen isn't always the exact price at which your order will execute. Understanding these basic terms helps you stop treating the brokerage app like a mysterious machine and start understanding what's actually happening when you press that buy or sell button. And once you understand what happens when you place an order, the next question becomes, what are all those numbers telling you about the stock itself? One of the first is volume. Trading volume simply tells you how many shares changed hands during a particular period. If a stock has 1 million shares traded today, that means 1 million shares were bought and sold in the market during that period. Now, here's the psychological mistake beginners make. They see enormous volume and assume it automatically means the stock is a great investment. It doesn't. High volume tells you there's a lot of activity. It doesn't tell you whether the business is good, bad, cheap, or expensive. Think of it like a crowded restaurant. A packed room tells you something is happening. It doesn't guarantee you'll enjoy the food. Then there's volatility. Volatility measures how dramatically an asset's price tends to move. A stock that regularly jumps 5% in either direction is generally more volatile than one that usually moves by 1%. And beta is another risk-related term. Beta compares a stock's historical movements with those of a broader market benchmark. A beta above 1 generally means the stock has historically moved more dramatically than that benchmark, while a beta below 1 indicates less movement. But here's what nobody tells you. Volatility and risk aren't exactly the same thing. A stock can move around a lot and still belong to a strong business. Another stock can look calm while carrying serious business or financial risks. Now let's move to one of the most useful concepts for beginners: an index. An index is essentially a basket or measurement designed to track a group of investments. The S&P 500 tracks large United States companies. The Dow Jones Industrial Average tracks a much smaller group of major companies. The Nasdaq Composite includes thousands of securities listed on the Nasdaq exchange, with a heavy representation from technology and growth-oriented companies. You can invest in an index indirectly through an index fund or an ETF, which stands for Exchange-Traded Fund. Instead of trying to identify one perfect company, you can own a collection of investments through one fund. That's diversification. And diversification matters because you don't want your entire financial future depending on one company getting everything right. Research from S&P Dow Jones Indices SPIVA reports has repeatedly found that a large majority of actively managed funds fail to outperform their relevant benchmarks over long periods. That doesn't mean active investing is impossible. It means consistently beating a broad market benchmark is much harder than it looks. Now we get to the terms that explain why simply staying invested can matter so much: compounding, fees, and taxes. Compounding means your returns can generate additional returns over time. Imagine you invest $10,000, and it grows by an average hypothetical 7% in 1 year. You now have $10,700. If that entire amount grows by another 7%, you're no longer earning that 7% on just the original $10,000. You're earning it on the larger amount. Here's the psychological mistake. People underestimate time because the early numbers look boring. But imagine person A starts investing $10,000 a year at age 25, while person B waits until age 35 and invests $30,000 a year. Depending on the return and time period, person A can potentially end up ahead despite contributing less money overall. That's the power of giving compounding more years to work. Now here's the catch. Fees work in the opposite direction. An expense ratio is the percentage a fund charges each year to cover its operating expenses. A fund with a 0.1% expense ratio and another charging 1% may sound almost identical, but over decades, those differences can compound into meaningful amounts of money. Then you'll hear capital gains. A capital gain is generally the profit you realize when you sell an investment for more than your adjusted cost basis. Tax treatment can differ depending on factors such as how long you held the investment and your jurisdiction. In the United States, for example, assets held for more than 1 year can generally qualify for long-term capital gains treatment, while shorter holding periods can fall under short-term rules. The exact tax outcome depends on your circumstances, so don't treat a simple definition as personalized tax advice. You should also know rebalancing. That's when you adjust your portfolio back toward your intended mix of investments. If you originally wanted 60% stocks and 40% bonds, but stocks grow until they're 70%, rebalancing means bringing the portfolio closer to your target allocation. Now let's clear out a few more terms quickly. An IPO, or initial public offering, is when a private company first offers its shares to the public through the market. A stock split increases the number of shares while proportionally reducing the price per share. So a 2-for-1 split turns 100 shares at $100 each into 200 shares at $50 each, all else equal. Short selling is when an investor attempts to profit from a decline in a stock's price by selling borrowed shares and later buying them back. Margin trading means borrowing money from a broker to invest, which can magnify both gains and losses. That's why margin can be particularly dangerous for beginners. Insider trading has a very specific legal meaning, involving trading securities while possessing material non-public information, and illegal insider trading is prohibited. The wash sale rule is a tax rule that can restrict the recognition of a loss when you sell an investment and acquire a substantially identical security within the applicable window. Then there are support and resistance. In technical analysis, support refers to a price area where buying interest has historically appeared, while resistance refers to an area where selling pressure has historically appeared. Fundamental analysis focuses more on the underlying business, such as revenue, earnings, debt, and competitive position. Technical analysis focuses more heavily on price, volume, and market patterns. And if you hear someone say a stock is at its 52-week high or 52-week low, they're simply referring to its highest or lowest trading price over the previous 52 weeks. That's a lot of vocabulary. But notice what happened. These aren't mysterious words anymore. They're labels attached to understandable ideas. Now here's what you actually need to do with all this information. First, open a brokerage account if you don't already have one, and spend some time learning how the platform works before putting serious money into it. Second, learn how broad index funds and ETFs work. You don't have to become an expert stock picker just because you've entered the stock market. Third, automate an investment contribution that you can realistically maintain. It doesn't need to be impressive. It needs to be sustainable. Fourth, increase that contribution as your income grows. A small increase repeated over many years can matter far more than one dramatic contribution you can't maintain. And fifth, keep learning while ignoring the noise. You don't need to react every time a financial headline tells you the market is about to explode, collapse, soar, or crash. Your goal isn't to predict every headline. Your goal is to understand what you own and why you own it. But here's the hard truth. There's a very good chance you finish this video feeling motivated, close the screen, and do absolutely nothing. Not because you're lazy, because doing nothing feels safer. You tell yourself you need to learn another 20 terms. You need more money. You need to understand every chart. You need to find the perfect stock. You need to wait for the perfect time. Meanwhile, someone else starts messy. They invest a small amount. They don't understand everything. They make mistakes. They learn what PE means. They learn what an ETF is. They learn how dividends work. They keep contributing. And 5 years later, they have something the person waiting for perfection doesn't have. Experience. More importantly, they have time on their side. You don't need to know everything about the stock market before you begin. You need to know enough to stop being intimidated by the language. Because once the vocabulary becomes familiar, the market stops looking like a secret code and starts looking like a system you can actually understand. So don't wait until you feel like an expert. Learn one term, understand one concept, take one responsible step, and keep going. The goal isn't to become Wall Street. The goal is to become financially literate enough that Wall Street's language no longer controls the conversation.